Well, we'll bring the meeting to order at 3 p.m. Just a note, because these minutes get done later in video, if you can, when you make a motion, give your last name, so people can easily do the minutes later. Appreciate it. Is there any board communications? Okay, Finance Director.
Okay, so, for the quarter ending June 30th, 2023, there was an increase in revenue of approximately 1.4 million. The majority of that increase was dividend income, which significantly increased. Unlike the significant decrease in fair market value that was reported last year at this time. We actually have seen a positive change in fair market value of approximately. As far as expenditures go for June 30th, we're at approximately 11.2, or an increase of 2.9 from the last quarter. Majority of the increase for that is related to pension payment, which is about 2.7. Other larger portion of that is the return contribution. Individuals that that was an increase in budget. Overall, I think.
So folks are asking to take their money.
It's usually.
Right, yeah, when
Yes.
they leave, but
Yes.
as opposed to pension.
Correct. Usually it would be one time.
I know. folks. You're
Mhm.
taking some.
We get the option. Getting a lump sum versus.
Meaning depending on the 10-year.
Invested in your retirement. We give people an option. Getting a lump sum. Monthly.
My knowledge, I
No,
think
but
it is.
that's,
monthly
that would
payments.
be something available once we get to the cash balance plan. That'll be enough. Which turned out to be way more complicated than anyone thought. So I'm hoping we get there at some point. The cash balance plan is the defined contribution that looks like I have some guaranteed get a certain amount of money. Yeah, so a couple of our unions have gone to that for a long process, a lot of details.
John, that's only the new employees.
Right. Didn't mention your pension. No. Nobody's watching you. Nobody's listening to the pension. Anything else?
That's all I have.
Hopefully everyone had a chance to look at the May 11th, 2023 meeting minutes. And whenever you're, first and a second. Any discussion? If not, all in favor, say aye.
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 Unanimously. Moving on to authorization of payments for retirement fund. We have 3 people under there. We usually do one motion unless there's an issue.
Member McNews.
I go for you in a second.
Okay, we have a first and a second. Any discussion? If not, all in favor, say aye.
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 That's unanimously.
Bill started.
Yeah.
It seemed like Bill just started. Yeah, well, you know.
On to SCI.
Great, thank you. I hope everyone's had a great summer so far. It's good to see everybody. I'll share the presentation here for everybody. Let's see here. Can everyone see that okay? Okay, great. Okay, so I'll go through the front end rather quickly, get to the performance. I know Mark will have some of the same information that I'm going to provide. I did put some unique slides in here I thought were very interesting, so we'll go through some of those in more detail, but I'll get through it very quickly. So let's just move forward here to the capital markets review. And as you can see here, we had a really strong rally across all risk assets. That would include US large caps, small caps, international, somewhat in emerging market equities, but high yield bonds and emerging market debt had very good 1-year numbers and a nice strong push in the second quarter as well. So risk assets were on this year, and we'll talk more about what specific areas of the risk assets did well. But also, we saw fixed income selling off. So we saw rates rising during the same period of time. So taking a look back to last year, we were in a scenario where if you were just getting ready for retirement 2 years out and you thought you had a safe portfolio within fixed income, you really struggled last year. It was one of those years where it didn't matter where you were, equities, fixed income, everything sold off together. That's not typically what happens. Usually one kind of protects on the downside, but last year was a very unusual year that we haven't seen in quite some time. So as far as US equity markets, last year we had discussions, or even earlier this year, we had discussions about last year. And really the trend last year was value. It was a value-driven rally last year. We had value, more defensive stocks leading the way. Those high-tech names were really the big losers last year. Well, there's been a complete change of leadership this year. So if you look at the bottom left-hand side of this chart on page 7, you can see that value actually was down about up about 11.5% for the year, and then 27% for growth. So huge delta there. We did see a reversal from what we saw last year. And then when you look at it from a sector breakdown, you can see that technologies, consumer discretionaries, communications, those more growthier areas of the markets did very well. Technology is really just leading the way. A lot of that can be attributed to the whole AI craze that took place. Anything to do with AI, NVIDIA, other stocks, Microsoft, all really participated as a result of the AI, what we've seen within the AI space in the news that's come out from that. Now, on the flip side, the more defensive areas, consumer staples, energy, and utilities, they actually underperform relative to all the other sectors. So it was quite a change. And I'll talk a little bit more about that on slide 8, which is very interesting. So we mentioned narrow leadership here. So this is through May, but it kind of holds true. Things changed in June. It was more of a push in defensive areas, which is good. But if you look at the S&P 500 as a whole, the dotted line, it was up about 9.6% through the end of May. Now let's just take the largest 10 stocks out of the S&P 500, and you can see those names on the right-hand side of this page. They were up 40%. So those 10 names really drove the S&P 500 higher. Now let's look at the rest. So take out the other 490 stocks. It's actually a little less than that. It's not quite 500 stocks in the S&P 500. You can see all the other stocks had a negative 0.1% return. So essentially everything was left out during this rally, which is, it kind of reminds me of what happened in 2020, right? So if you remember then, we had the huge tech rally and the stay-at-home stock names like Zoom and things like that, which had like 400% returns. We saw that again somewhat this year. But again, in June, we started to see that correct itself somewhat. A lot of that had to do with rates rising, and the tech names traditionally don't like when they see rates continue to rise. But when they hear about maybe a pause from the Fed, we see them rally. So that's kind of what really happened this year within the tech space, and that AI thing, which I mentioned as well. Any questions about what's leading the equity markets higher? Okay. So international equity, actually international equity had a little bit of a run. It won for like 3 straight quarters, which is, we haven't seen that in over a decade. But actually, when you look at it on a year-to-date basis, it's slightly underperformed the US. So just looking at developed international ex-US, you can see that it's slightly underperformed. US is up about 18.9% and developed was up about 17.4%. So having allocation to it didn't really hurt you. It actually helped. But again, we want to stay diversified in these areas. We still like international. I mean, it really hasn't participated the way the US has. We did increase your allocation slightly to international. We do think that's, might be a little ahead of that move, but we think that is a good move going forward because you had a tremendous overweight to the US, and we got you a little bit closer to what the global GDP is across the globe. And then finally, fixed income. Obviously, a lot has happened here. So we had our 11th rate hike at the last Fed meeting. Now, I mean, the consensus really is with some of the inflationary data that's come out more recently. It has been more of a disinflationary trend. So that's positive, right, for the overall markets. That's giving the Fed some ammo to take a pause here. But their job's not done because there's still a lot of things impacting inflation, such as the Ukraine-Russian war, other areas, hotspots in Africa, things like that. There's still a lot of pressure on supply chain. So with that being said, right now, a lot of economists are starting to believe, knock on wood, that we may see a soft landing out of all this. We're kind of split between that right now at SEI. We still think there is a possibility for a very kind of moderate recession that won't last long, but we do think there might be a dip in the market ahead. But all in all, the data is looking better. Now, if you look at numbers like GDP growth in the US, they slowed a little bit, but not as much as anticipated. They're still relatively strong given all these rate hikes we've had and the inflation. So the consumer is still spending, and that's really helping the economy here. Even with all this inflation, they really spent right through it. So as long as they're spending, we most likely won't run into a recessionary period if that continues to happen. Any questions around fixed income? It's our judgment there might be one more rate hike, but after the data that came out today and last week with inflation, there's less likelihood. They probably will take a pause here and just hold us at a higher level for longer. Some economists believe this year we might see some rate cuts. We don't think that's in the cards for later this year. The only reason we would see that is if we saw kind of a moderate recession next year, maybe see a couple of rate cuts as a result of that. So it's important to be well diversified across fixed income. We've diversified you a couple of meetings ago. So we really think you're in a good position going forward, regardless of what happens with interest rates. Questions around the capital markets? Okay, so we'll just get right into the numbers here. So as of the end of June, the portfolio was 137,688,765. And your year-to-date performance, so you're up 8.9% gross, 8.8% on a net of fees basis, and we outperformed the index of 8.6% at the total portfolio level. So really strong absolute returns this year. It's great. Obviously, we had strong negative returns last year as a result of what happened. So we did get some of that back. So positive. US equities, when you look down on the year-to-date column, they were up 14.8%. Large cap equities led the way. They were up 16.7%. US equity factor-based allocation, that was a move to position away from some of the riskier areas within the S&P 500. So you had a large portion to that. Now we took a little bit back saying, okay, let's just remove 5% of the portfolio, put it into more defensive areas of the markets. This will control volatility over the longer term. So you'd expect this fund to do well in a downturn. And when you have large cap stocks, especially tech names running high, you're going to see this fund underperform. So that's why that one underperformed. Then you have the small cap side of the equation. That was up about 6%. So small cap lagged the large cap area of the markets. On the international front, we were up a total of 11.2%. The Fidelity International was up 12%. And the Vanguard Emerging Market stock was up 4.75%. Fixed income, that's where a lot of volatility has happened. Last year, if you remember, core fixed income had a strong negative return because rates went up so much and it has longer maturity, so it was impacted. This year, we're up 2.94%. Limited duration, which we just moved the portion out, that's up 1.8% on a year-to-date basis. And then high yield bonds and emerging market debt actually came in really nicely here. So risk assets were on, we saw 5.7 from high yield and emerging market debt of 7.8% return. So that's that fixed income diversification I'm talking about to give you, a nice diversified fixed income portfolio to protect on interest rate movements. And then finally, the real estate fund, that's a REIT fund. So obviously that was down big last year. That had a nice comeback. That was up 6.9% so far year to date. Questions on performance?
Nope.
Okay, well, that's all I had.
Thank you. Mark?
All right, let me share my screen, and as Pat said, there's some overlap in our presentations. We both give a economic update. Are you able to see my presentation?
Yes.
So I won't cover the same. We took a slightly different look. If you are interested, to Pat's presentation, I think they kind of carved out the top 10 holdings of the S&P 500. We called out the top 7, the big 7, as they've been referred to, technology stocks. So listed below, and did kind of a similar analysis. So our hope is that this market rally can broaden out a little bit. Again, 3/4 of the S&P 500 return was attributed to just those 7 stocks. So similar type of slide there. If anyone is interested, there's an additional page on AI, since that really kind of led the way, especially in the second quarter with NVIDIA and other stocks that it had just eye-popping performance.
I've called these other companies. What is NVIDIA? What is that? I've never heard of it.
It's an artificial intelligence company.
It's actually a chip man.
Yeah, they do graphic cards too for PCs.
And they started by in the gaming business. They do PC games. People play video games. So it's NVIDIA for video. And then the chips were so good they did for games because they need really high processors. And they've been really useful for this artificial intelligence. So these guys got very lucky. They invented a great chip that works really, really well.
Yeah, and then initially not a lot of competition. There's some smaller competitors kind of popping up as well, but it's kind of hit the sweet spot. So I would agree with most of Pat's comments, or probably all of Pat's comments. With the soft landing, it seems like a little bit of a reach, just because it's such an incredibly hard thing to do, is lift interest rates just enough to quell inflation, but not to break anything or cause a recession. There's some economists that have thrown out the idea of a rolling recession. So normally when you have a recession, it tends to be a slowdown across most industries. We have seen that throughout certain industries. Energy, tech sector last year saw a lot of layoffs. Commercial real estate's kind of a weak spot. So potentially it could be a little bit more of a rolling recession, where sectors at different times throughout the market cycle experience a recession. That's just kind of an interesting stat there. And I think, we put together our list of positive, neutral, negatives. I think Pat hit most of these. Only 3 positives, but they're really big. People that want to work are working, and wages are going up, which is allowing them to spend. And, starting to get a little nervous about credit card debt. We're starting to see that reach all-time highs again. And as Pat said, just people are spending through that higher inflation and spending on different things, and that's propelling growth. So, we 2 quarters ago, we were talking about the potential for a recession this year and maybe rate cuts. We think that's almost off the table at this point. If we see a recession, probably be mild and probably be in 2024. It looks like the odds really changed on interest rates after today's news. I just saw a stat, 90% expectation the Fed will not raise rates in the September meeting, just based on the CPI data today. So we'll see where that goes. So that will remain, I think, more importantly, whether they raise rates a 1/4 basis point or not, it's more about the messaging about how long will they keep rates high. And then kind of when could we expect rate cuts? Rate cuts are generally good for everything, you know, bring down lending rates, it stimulates spending, more spending. It's good for stocks, it's good for bonds. So at some point, rates will have to come down. If you have, you know, short-term rates at 5.5 and inflation gets to 3 or 2, or it already is at 3, you know, that's usually a disconnect, and you'll see the short-term rates just slightly higher than the inflation number. Similar chart, you know, for those who like graphs, you know, similar chart looking at US versus international emerging markets, big, small, and medium, and then a look into the S&P 500 on the right-hand chart. So again, don't want to waste time going over the same slides. And then I always like to look at the yield curve. That's historically a symbol or a warning sign for a recession. So the bottom chart on page 9 of my presentation compares short-term rates, you know, 1-year intermediate rates up to 30-year treasuries on the far right. So you can kind of see historically over the last year how rates have risen across the board, but most importantly on the short end, which has created what they call an inverted yield curve, where short-term rates are higher than long-term rates. And 100% of the time since the 1960s, that's signaled that we have some type of a recession. And it's a little less accurate going back to like the Great Depression, but still a pretty high percentage when you have that inversion of interest rates. So something to think about, but yeah, I think there is a chance that we could have that kind of miraculous soft landing where we don't break anything. Second part of my presentation, you know, covers the assets, the asset allocation what Pat went through, the rates of return versus benchmarks. So covered all that. As you know, what our role is to kind of put another set of eyes on the SEI funds. We use a proprietary scoring system. It looks at 9 criteria. You know, a lot of times we just focus on performance. You know, as individual investors, we kind of just compare about that performance. That's the biggest thing we look at, but we look at how much risk funds take. So we measure that a couple of different ways. And we're looking for consistency. There's a criteria called batting average and rolling 12 months that look at how consistent the returns are versus their benchmark. Kind of to eliminate funds that might hit a home run in a given year, but then kind of strike out, using the baseball analogy. You know, have very bad years followed by very good years. We'd rather see a slow, consistent type of performance. So we look at how funds perform up market like this year. More importantly, how do they hold up in a down market like we had last year? And when we apply those scores to the funds in the plan, they score in the 19th percentile. Lower is better with our scoring methodology. So the range goes from 1 being the best, 100 being the worst. So on average, our scores are beating 81% of their representative peers. So that's obviously excellent, a little better than the last time we met. And if you take a look at the next slide, blow it up a little bit. I'm not sure if you've got the printed copy in front of you. All the funds are passing our scoring. So what we hope to do is have all of our funds in the top or second quartile. As of 6:30, all of the funds pass. Emerging market debt, which was a new fund added last year, initially scored in our 3rd quartile. Since it's been in the plan, it's outperformed. It's actually provided very good performance. It's a very small, it has a very small peer group. So unlike some of these that might have 700, 800, 1,000 peers, emerging market debt isn't a super popular category. So it only has a couple hundred funds. So you might see a little bit more variability on the score. But again, since it's been added to the plan, it's been a positive, and we've seen outperformance. So all passing scores, if any fund is in our 3rd or 4th quartile, that's when we'll add that to SageView's internal watch list.
Can you comment a little bit on expense ratios, you know, versus you know, consumer funds with Vanguard or something like that? He's like,
yeah, excellent question. And I I oftentimes forget that, and I get a lot of questions. This is the expense ratio ranking. So not the actual fund expense.
All right, great.
Yes, my apologies. So this means that the fund is cheaper than 97%.
I get it now.
Yeah, the real estate fund's a little bit middle of the road in the 61st percentile, but that includes active and passive. So, the SCI fund is actively managed. All the other funds are actually top decile, cheaper than more than 90% of their competition. Thank you for pointing that out.
Patrick's very happy to get your.
Yes. Yeah.
Loves
We
that.
wouldn't allow, we would have to fire them if, they were charging 3 to 6% on the funds. So we'll continue to watch that emerging markets debt fund, just because it did score in the third quartile for several quarters. But as I mentioned, we're back in the second quartile. That one's going to be a little bit more volatile. It's really just a diversifier. It's only 3% of the portfolio. And since we've added it, it's outperformed. So it's had no negative effects whatsoever. And then I've just included the historical ranking and everything back in the green, and we've had consistently good performance from the other funds in the plan. We're comfortable with the international overweight. It seemed counterintuitive just because the US has outperformed so long and so much more. As Pat said, getting a little excited, we saw 3/4 of outperformance from international. And then really just the AI explosion kind of pushed the US markets ahead of international markets. Again, take out a couple stocks and the international rally was actually much broader than in the US. And just prices are much more attractive. I think when analysts look at funds, they're just much cheaper and have a better, more potential for growth going forward. We're similar on some of the clients that we manage in Pat's role, and our wealth management clients are slightly overweight international as well. We're just a little early. Any questions from Seiju?
Taking in our portfolio grew more than a lot.
I just had if that was a question for me, I had a little trouble hearing.
Oh, yeah, no, that's not a question for you. No.
Oh, okay.
Do we have a way of measuring variance standpoint, what the expenses are going to be going forward? How do we know, if we're really overfunded or underfunded?
Well, I think
That's that.
for not
I think it'd be helpful. Because if we had a bunch of people like Bill retiring next year. Faster. Realize that if everybody, all the employees. 25%.
Are you asking if you were to forecast those that are eligible to retire if they were?
Yeah,
If we would be
how do we,
able to absorb.
there is a report
Yes.
done here. Ultimately. Used to. Regular consumption.
If we have good news, is that
It helps our, exactly.
That's where
exactly
it's
what
done.
it is. Yeah.
It's done every year.
Yeah.
Should be. Yeah. I see. Try to keep it. Right. Once it does this, it's very tough.
Yeah.
The town is obligated. This. That's still on.
I think we kept it there this year, did we? We left that summary in there.
I think that is in
Yeah.
there, but we provide the information the action. Or forecast. What is accounting for if those were retired. So, as you mentioned,
So
so
it-
then if that was the case, then they would ask, or they would recommend. Need more money.
Maybe I saw that. I mean, well, this would be in the budget. There is a separate document that is referenced.
We gave everyone before, yeah.
Maybe.
We do a good job. We do a good job.
Yeah.
We do a good job.
Ideally,
Yeah.
or if the market does a good job.
Yeah,
Yeah.
yeah, yeah.
But, I mean, my ears were working early on, in the discussion, just like at the very beginning of the meeting. Historically, ideally, you don't want people. That's not a good thing. They have the right to,
Yeah.
but you don't really,
Well,
most
they take
folks,
a lot.
from my experience, only the police sometimes they, because they're gonna start a second and a third career. They're gonna go on trooper, or whatever, homeland security or whatever, or they want to start their own business. Historically, you don't want folks to take their career, because it will show up in this valuation that's done at the airport, which helps the town decide how much.
So if we're doing a bad job, that would be like, hey, what happened? All right,
I mean,
like, were they watching it? So if we do a good job, it's apples.
the market's the market, and our job is to determine, do we have the right mix? And that's why we have these folks on help us determine, is this the area that we should put our money? Tweak it a little bit. I think what I'm hearing from Mark and Pat is stage a course. We're in a good place. I think that's what I'm hearing. No reason. You don't want to start playing the market. That's every once in a while we do meet national. Those are usually.
Yeah, I guess what it would be useful. Is this good news or bad news relative to what we get?
Okay.
And to what degree is it good? If the stock market doubles, right, we say, wow, that's really good news. Obviously, that's not good, but like somewhere between 0 and doubling, there's a great point where it's down.
But I think my sense is, John, you may have sent it out. Looking at the evaluation, at least the summary, it is a little. But that at least tells you what is projected. Probably in March, right? What's projected over a couple of years.
Actually,
I'll resend them out, so just make sure. Close the excerpt. Mark, did you have anything else? Okay, thank you very much. All the questions. Policy workshop. Carried over. Unfortunately, anything next one. I'll tell you what, we'll either send us, email out for the pact or have it up. For next month. We'll move on to 7.2, and I think you saw it in the packet, the bill that passed. Public act that passed, it was House Bill 6830. Public act. The primary first part is concerning revisions to the municipal employees retirement system. The state plan, it's got police officers, firefighters, board of ed, public works. That's the first part. They also, as part of the bill, have to, there's a year to come up with best practices for pension funds. What we don't know is after that year, whether this is going to be just for the state system, is this going to be something that's pushed at all? And maybe, I don't know if you guys know anything online about what's coming with that, but and then right now they're collecting information for municipalities on our pension plans. We also don't know is there going to be a push in the future to try to get more of us or push us towards state plans. So we really don't know what the ultimate plan is at this point. This year, we're just at the collecting information stage. I assume we'll feed into that best practices phase.
So John, is it thought that each town or each retirement board needs to come up with best practices?
No, they're going to come up statewide,
Okay,
right?
and
Which
we-
primarily will affect the municipal employees retirement system. But since they're collecting our info too, I'm assuming they're going to push stuff towards us at some point. Yeah. The underlying concern is hopefully leave us on our own plans if we're successful though.
Yeah.
At this point, we don't want to be in this.
Can I ask why we don't want to be in the state plan?
They're doing this because it's not performing.
Have we ever done a 5-year look back, 7-year look back? Between what we've achieved and what?
It's been looked at briefly before, but I don't know if there's a real. I mean, yeah. But they historically have not done well with that.
It has been looked at.
Yeah, it has been. I just don't know if that get forward.
You know,
Yeah.
What would our contribution have been?
Well, just because I sat on the IAC for over a decade, but I've been offered. I was just curious and surprised because I didn't pay attention this time. When I became interested in joining this group, that we were not involved
Understood.
at any way, shape, or form, because, for instance, the teacher's plan is doing very well compared to others. State plan, way under. And I never paid attention too much while I was sitting there now, because it was so small compared to the $26 billion.
Yeah.
So it was,
In part,
it was an afterthought on my part, not the state.
No, it's worth looking. I'm not saying don't
I
look
think
at
it's
it.
separate.
It's-
I mean, I'm just looking at the cost. There's that as an independent group, there's scale of things. For instance.
That was my thinking as well. And number two, the diversification that they're able to do compared to $130 million is way. However, I can only go on both of you guys' experience that we've outperformed. But it would be nice to see it on a piece of paper. I'm just looking for like the year end. But over a course of time, because you got the pandemic in the way, and you certainly don't need to go back to the session. That's just all screwed up.
It's a course of time. Yeah, I mean, there were opportunities for the town, for any town that wasn't
Right.
to join, and you had to pay a premium because they were looking at it as a way to make up for the deficit in the
Right.
state plan. And
we also
You know.
look at the health plan for the state every now.
Yeah, and that's kind of gone. The teachers union, but it's gone south.
I mean, possibly maybe one of our consultants could look at, one of.
I'd
our
just be curious to
advisors.
see a 7 or 10-year look back on what we've achieved in our own plan versus what the municipal sector and state pension plan did.
Yeah, it was-
Yes, absolutely. Yeah, because that would be the quote unquote saving if there were one. I don't know.
I think there's a simpler way at it. Because, and it would be, if the town belonged to the state plan, what would we have to contribute? The town contribute every year to that plan versus what do they have to contribute now to this plan? Which is a budgeted item every year. If the assessment says they need, you should. Yeah, those to me are comparable. Looking at fee, you're never going to figure out what the fees are for the state. It's the bill. What is the bill that the town will receive if we convert our program to be part of the state? That's a separate, issue. I think it would be easier just to say if we all went away and forget what's in the fund, we wanted to now participate in the state program. Because there's going to be a buy-in cost. And they're not just going to say, well, it's $3 million a year and you've got. That's what I'm just using it.
But I think it would be very careful consideration. Why would we join a group that historically has not?
Well, historically,
Well, that's the
it's just the last, and just to know.
And I know since I've been, every time we had their input, they would say, oh, and I would ask too, well, what are other municipalities or the state or whatever doing? They always said that they would be bad and we were doing good.
And just to note, the state right now is at 68.7. They were considered very healthy into 18, then it plummeted from 91.68 to 72.69. Is that when the bad budget was hitting, they made all the, and then they did deals with unions. So that's probably what led to that a little bit. So now, part of what they're doing in this act now is, right now, I think they get a minimum, they get an automatic COLA every year for the retirees. They're phasing some of the automaticness out. They're gonna make it more based on CPI rather than just automatic. But it's gonna take like, it's phased over many years before they really get to that point.
And the number, the 68, that's what their plan is funded at. A 60.
Or we dipped some in the last year, we're up, what, 80. We're low up.
The answer not exactly the same as it's always been, but I think it's. Okay. That's absolutely, we're spending a lot of maintain a separate thing. Money could be better.
And if we anything, so HR is going to try to pull together the information they just requested, right? And we'll see where that goes. Is there any other business?
Now, going back on the workshop, I'm drawing a line too. I mean, you've got a referral.
I feel like it's a carryover, but
Were we going to
Our
have a
nation should
follow-up
be-
session?
We had one time.
Workshop. We usually do that in the summer, so
we'll figure it out.
where we go back to our investment policy.
Yes.
Yeah.
We would have sandwiches.
Yeah.
It was a long haul.
Okay. So we'll get, we'll figure out what that was for. But next meeting is November 9th, if that works for people. Is that still okay with people?
Yeah.
Might be busy rubbing it in.
Engine pay, so I need to get a job.
Oh, here we go.
You like farm
State
work?
plan.
Do you like farm work?
Okay, so we will look at it. Entertain a motion to adjourn. All in favor, say aye.
Aye.
Stand adjourned at 3:45. Everyone.